The U.S. debt ceiling has been making international headlines, especially with the increasing risk of default. And you can see that with the cost of insuring U.S. debt now reaching a record level higher than it's been for the past several decades. One way of measuring this cost is by looking at 1-year U.S. credit default swaps, which are now cost around a little under 2%. The way to think about this is for every $1 million of U.S. Treasuries you want to insure, buying 1-year credit default swap, so that gives you 1 year in terms of a payout, it would cost you a little under $20,000. Now, if the U.S. were to default, then the counterparty that you're dealing with would effectively have to pay you $1 million, even though you only put up $20,000. So that $20,000 is the cost of insurance, that credit default swap insurance. This is much higher than it's been in previous debt ceiling episodes, and it's worth calling out. Look at this 2011, which you're looking at the prior years, none of these approach that 1% hurdle. Now we're closer to 2%. So this is an important data point. I will talk again about 2011 post debt ceiling, the potential impacts on the economy in just a little bit, and why 2011 is worth understanding. And so looking at this, there's also been an 8-fold increase in terms of the volume in CDS or credit default swaps. Now, it's unclear how much of that is from institutions looking to protect their downside versus, the terrible and catastrophic risk of a U.S. default, which once again, the marketplace is currently pricing around under 2%. Versus, let's say, speculative hedge funds saying, hey, we think there's going to be some Washington brinksmanship. Let's buy it because, it's going up and it's an asymmetric bet. And maybe we get out before, the Congress reaches some sort of compromise. So it's unclear how much of this is, just purely speculation versus institutions trying to protect themselves. Now, looking at how U.S. Treasuries, how the U.S. debt market is currently pricing risk in. And keep in mind, the U.S. debt market is one of the most liquid markets in the world. You can see that it is baking it in slightly. Now, this is the yield curve, meaning from 1 to 6 months, you can see what it would cost. So currently U.S. debt, if you were to buy U.S. bonds that mature in 6 months, cost you, you'll get around 5% yield on that. That's the return that you would get for buying 6-month paper, is effectively a 5% interest rate, a little bit over. Whereas you could see 1 year through 30-year, 30-year paper is under 4% rate. Normally, when you're looking at a healthy yield curve, the shorter duration, let's say the 1 to 6 month, is a much lower return, much lower interest rate than what you could get from 10 to 30 year, because investors say, wait a second, I'm lending this money to the U.S. government over longer periods. I'm taking more of a risk. But now you're seeing a little bit of a different dynamic. Now, a big part of this is because of recessionary fears that the economy will slow and interest rates will go lower in the immediate term. And that's part of the reason why you have this inversion where short-term rates are much higher than long-term rates. But a part of it also is due to the fact and concerns of a U.S. default. And you can see that with, let's say, the 1 to 6 month paper, where you can see the 1 month is currently a little over 4%, and then it sort of spikes out closer to 3, 4, 6 months, time period. And this is really a reflection that investors would rather have the shortest paper they can have, the shortest U.S. debt that they can have, shortest duration, versus dealing with that potential risk of a default in 3 to 4 months from now. So that's the reason why the yield is so different, from a little over 4 versus a little over 5%. It is a big difference, and that's a big part due to this debt default brinksmanship, where people are saying, hey, will the debt ceiling effectively get raised? Another way to look at it is how the Treasury yields have changed so far in April alone. Broadly, looking at the 2-month all the way through the 30-year, it has been creeping higher. The 1 month has dropped lower, and that once again, that's because people are moving into the shortest paper they can get, the shortest duration risk paper they can get. And so you are looking at higher costs of doing business for the government. And so just very simple framework. With over $30 trillion in debt, every 0.1% increase due to this types of brinkmanship is another $30 billion in additional interest payments. This is cash that could be going to paying down the debt, cash that can be going to basic programs that help the citizens of the United States. And so it's really disappointing to see this brinkmanship really leading to unfortunate consequences. $30 billion, that's real money, and arguably it could get a lot worse. Now, you might look at the latest headlines, which include, Republicans in the House talking about, hey, we're looking to pass a debt ceiling bill, but it's pretty much been said there's no way that this goes by Democrat senators or President Biden, partly because with this bill includes a limit for how much the debt ceiling can get increased, $1.5 trillion, or until March 31st, 2024. So it's a very short-term oriented bill, and it also caps the amount of spending that they can do in the future. So it's sort of conflating two different things. Now, the reason why I say it's conflating two different things is you need to understand the debt ceiling is a vote on the amount of allowable outstanding U.S. federal debt. Congress has already approved in prior presidencies, prior sessions of Congress, they've already approved this spending. It would be akin to you saying, hey, I approve that I'm going to go spend all this money, but then getting into a fight with yourself over the limit that you're going to set on your credit card. Well, you've already approved that you're going to go buy all these things, that you're going to go spend all this money. Whether or not spending all this money is a good or bad thing, that's a whole separate other video. I'm inclined to say we're overdoing it with huge deficits, currently around 5-6%. That's a whole other separate video. But this idea of like, hey, we previously already approved it, but now we're going like, oh, well, this credit card limit only goes here, even though we've approved this much. We've already said we're going to spend this much, but we're keeping our credit card limit here. It just doesn't make sense. It's, one hand not talking to the other. It's absurd, really. Okay, so what happens from here? Well, first of all, in full disclosure, this is not financial advice. And so in terms of thinking about an actual default, according to the Brookings Institute, they're saying it could happen anywhere from early June to early fall. So this is in line with what markets were showing, what I was showing with the Treasury yield curve, where it's sort of saying, hey, that peak risk somewhere between 3, 4, 6 months from now. And so that's what you're seeing, with the estimates of where the Treasury runs out of money, where you have that quote unquote X date, where it's big problems, where you reach this point where the U.S. cannot pay its bills. Now, the reason why this is important is, and I'd argue, even if the U.S. gets their act together, and I think at this point, this is part of the reason why, approval for Congress is so low, is because you have things like this, where it's like, it's some sort of kabuki theater versus a real understanding like, this, we already approved the spending. It's absurd. Like maybe there should be real consequences for the congressmen to actually get this done. Like maybe they shouldn't get paid, or maybe they would all have to personally file bankruptcy if the U.S. defaulted. Maybe we should have some sort of incredibly harsh penalty for this. Like get your job done. Like figure out a way to make it work, because this brinksmanship, even if you do manage to get your act together in the last minute, it can still have consequences. For example, in the prior debt ceiling, debacle, one could argue, in 2011, even though Congress managed to get their act together, it still resulted in the S&P downgrading the U.S. from its AAA rating. Now, someone could say, well, this is kind of silly, like they shouldn't have done it. But realistically, if you're to try to be an impartial investor, global investor, you're, an alien from another planet, and you're looking at this, does this inspire confidence? Does this make you want to say, oh yeah, I'm going to trust you. I'm going to loan money to you at 3, 4, 5%, 6%. Does that make any sense? And so I look at this and I'm thinking, okay, the key takeaways that you investors should understand is, one, it's still a very low probability event. It's still 1 to 2%. That said, like if I said, hey, here's, Russian roulette, there's a 1 to 2%, it's a pistol that, has 100 slots, and I've only put in a bullet in 1 or 2 of them. Here, let's play, but by the way, there's no upside to you. Like, would that be a game that you want to play? No, it doesn't make any sense. So to even play this game is just absurd, and it has real costs to the tune of at least $30 billion a year. At least. So we're shooting ourselves in the foot. It's, self-inflicted. And the downside of like, hey, if you don't get your act together is just truly catastrophic. I mean, you're talking about investors around the world say, hey, we are not going to put money in US dollars. We're not going to buy treasuries. Interest rates spike higher. Financial institutions default. Basic costs of, basic services, are suspended in the United States. Basic payments for the elderly that get, you have so many ripple effects where it's just like the whole country could start having real problems. Basic services shutting down if we go this route. Now, once again, market is saying it's a 1% to 2% chance. Honestly, that seems like a realistic, maybe it's slightly lower, but no one, like, why even play this game? Now, I personally look at this and I'm thinking the equity markets aren't pricing this in. I mean, you could argue sometimes equity markets are significantly disconnected from everything else. And that's what happened previously. Previously in 2011, that's what happened when all of a sudden the S&P downgraded because of this, and then the stock market fell a couple percent. Same thing happened with Michael Burry. He was buying CDS. He was like, hey, the cost of CDS was going higher. The market didn't really reflect it yet. So looking at U.S. equities, I think it's disconnected from this. I also think it's disconnected from the underlying earnings, which haven't been great, or the valuations, which isn't deeply compelling. And so I personally, when I'm considering my own investment journey right now, and I share the details of my investment journey to subscribers at unrivaledinvesting.com, I'm being very, strategic or tactical right now, where I want to make sure my personal investments have really high upside potential. So really high hurdle rate. My most recent top 5 bet that I made, that's a company that I think has over 300% upside from here, maybe more over time. And so that's the type of thing that I'd want to have right now versus the typical, like, hey, things are hunky dory. Maybe there's 50% upside with something that I'm penciling out. So I want a lot of upside. I personally prefer holding more cash, and I have been, and that's how I'm personally looking at this right now. I suspect the debt ceiling will be raised in time. I just feel like either the secondary effects of either foreign investors or investors saying, hey, we don't want to own U.S. treasuries, and then the higher interest rates. And then, keep in mind, if foreign investors pull out of the U.S. market, then the U.S. dollar falls significantly. Then inflation becomes greater, more entrenched. And the more entrenched inflation becomes, that eats up middle class. And then you start having, riots in the street type of event. I'm not trying to scare folks. I'm just trying to share how these things play out and why it's extremely foolish for Congress to even be playing this game. It's insulting to the U.S. public, in my opinion, looking at it. Like, it's hurting the U.S. public with the higher cost of interest. And ultimately, it's based on a silly idea that, wait a second, you already approved this spending in the past. Congress already approved it. So it's insulting to the American public. And I wish Congress got their act together. I hope this video has been helpful for you. And thanks so much for tuning in to Unrivaled Investing.